Welcome to the Eat and Drink Real Estate Podcast. I'm Laxmi Sarathy, your guest host for the podcast, and today I have with me again Mr. Paul Chawla, our wonderful attorney, real estate attorney, expert real estate attorney here, and we also have Mr. Chris DeJong. Is that correct?
Yes.
And Mr. DeJong, your mortgage broker. I did that before. You're a mortgage loan officer, lender?
Mortgage lender.
Lender. And we're going to go through all those differentiations, different distinctions. And, I'm a bankruptcy attorney. Well, I've been a bankruptcy attorney for many years, and we were on the opposite side sometimes on the same
15,
side.
20 years ago, yes.
Now we all work together, right? Paul, we already had a brief conversation about, your background, and we have a little.
We went through a lot
somewhere
of
here. We're going to have a link to that episode for our viewers. Today, I want to talk about Chris. Your background. Can you tell us a little bit about yourself?
I got started in this business probably about 1990, doing subprime loans for a finance company.
Which one?
ITT.
Ah. And
from there I segued into working for a mortgage broker to start out, and then got to work for Old Kent Bank while they were still around. Segued that into a 10-year career at Countrywide. Then they were bought by Bank of America, and before that I did a couple years at Harris Bank, and I've been at a company called Prime Lending now for the last 12 and a half years.
Incredible.
So I've got about 30 years of lending experience.
So we don't have any of those toxic, I remember when I was in school and studying about banking law, we had these, we studied about these special purpose vehicles where you had these, stellar credit rating mortgages on the top, and then you had all these, BBB rated, and then all the way to the bottom you had these subprime, absolutely toxic mortgages that was eventually just squeezed into a lot of them. A lot of these securities, they were securitized, and eventually, you can securitize zero, it still becomes zero, right?
Correct.
So, and then we ended up having a lot of these securitized mortgage loans that, eventually were sold in the open market. That market is not there at all right now, correct?
And the difference in what happened and what you learned in school was you had tranche, you had a pyramid. Well, the pyramid went away, and just the bottom of the pyramid was being traded, and they paid you more for that. So that created another problem. They were paying you more to do bad loans than they were to do good loans. So what did everybody do?
They did all the bad loans.
Yes.
So there was another thing that we went through and hopefully learned from the last crises, the 2008 crisis, which incidentally was when I graduated from law school. A lot of those modifications, like when people started to go into default, there was just absolutely no modifications. Anything that you're seeing in the industry right now, or it hasn't even hit that right now?
Housing's going up, it's not a problem.
That's not a problem right now.
And in 2008, you had a whole new industry of foreclosures and modifications that there was zero experience in. You had to create a new network of servicing that until that time did not exist. There was, sure, you're always going to have 1.5%, 2.5% delinquency and foreclosure rate, not 40%. The experts in that industry didn't exist at that time.
But Chris, how are banks, because even now you have foreclosures, there are distressed loans.
Mm-hmm.
How are banks handling distressed loans now? Short of getting to foreclosure, are they still creating mechanics to put it on the back end, to restructure it? From what have you seen from your experience?
What I'm seeing is they just want out. They don't want to prolong it. They will just foreclose and take the house.
So they're being aggressive in the process versus working it out
they're cutting their loss. They're cutting their loss. You will see, and we saw a very little bit of it, and I mean a very little bit of it during COVID, where people were losing their jobs and they'd tack things onto the end
Right.
and do a modification. Generally, modifications are very difficult to find right now.
No, I agree. They're far and few between. That's why I'm wondering if there's so if the objective then is to just get the asset back, and I mean, that's going to really trigger more foreclosures again. In the event that if that's going to be unless there's another, if there's some sort of a umbrella or some way that they have on the back end to try to resurrect these loans and keep the people in the homes.
Well, I think if you go back to 2008, we had a perfect storm.
Yeah.
We had so many things all at once. If you've never watched the movie The Big Short, watch that movie. It's dead on perfect,
I think
funny.
we were talking about that last time.
We were talking about that in House of Cards.
But you're never going to have all of that happen at the same time again. Never say never, but
Never say never.
the odds are significantly against it. Countrywide went out of business. Countrywide really wasn't a bad company. They got caught up in a liquidity problem, and the market froze, and they couldn't get to capital.
Well, Washington Mutual.
Washington Mutual went out way before that. That
was actually
that
a
was
class
the S&L.
project.
Yeah.
They were giving out dividends just before they went under.
And their main product was that option arm
Yep.
with negative AM. To worry about the foreclosure issue coming back on a large scale right now. We have a housing shortage. Prices are going up. You're
That
still
was
going to have
actually-
foreclosures and hardships, but I don't think it's a national problem.
That was going to be my next, question/comment that I wanted to elicit from you. Right now, we have a really interesting situation where we've got a shortage in the housing market.
5.5 million homes.
Right, and then we've got a huge, everywhere we go, we talk about the inventory problem, the housing inventory problem. On the other side, we also have a situation where a lot of potential mortgage applicants are struggling with getting their loans approved. And how is that interplay working out in today's market? And how do you see that playing out?
The approval process right now, I would not say it's difficult. Where people I run into, where I see people struggling, they want a $500,000 house and they can afford $350,000, and they're not willing to accept that. It is what it is, I tell the people that are on my team or that work for me, one of the things when you're talking to a client, the client's always right, but they're not. You have to be honest with them. You simply can't afford what you want. This is what you can afford. If you want that, you need to make more money or pay off other debt if you have any. But this is, in today's world, this is what you can afford. It is what it is. It's not. Fortunately for me, I let the realtors find the houses. That's their job. My job is to just run the numbers and advise the client. This is what you can afford. So is it hard to get approved credit-wise? I would say no. The tools that are available now, especially with conventional loans, make it significantly easier than it was even 3 years ago. But buying what you want is a separate issue. Everybody wants what their parents had or better. The generation growing up right now is the first generation that won't have their parents' standard of living.
Right.
So you brought up something earlier, talking about the process and from your perspective on what's realistic just now. And there's pre-qualifications and there's pre-approval. Tell me a little bit about the two.
So pre-qualification is you as a buyer get on the phone and you call the lender, tell them how much money you make, and they're going to run your credit. And they're going to give you a letter that says you can go buy a house. That letter isn't worth the ink that was used to print it. I typically won't do those. I only do a pre-approval. So the difference between the two is a pre-approval. You're going to give me your bank statements. I'm going to get your income docs. I'm going to pull a full credit report on you. And I'm going to send you to an underwriter, send you through the automated underwriting system, and I'm going to send you to an underwriter, and the underwriter is going to look at your income and look at your assets, look at everything in there, look at your credit profile, and we're actually going to approve you subject to finding a home. So now as a buyer, when you go out and buy a home, all it has to do is appraise. We're taking the horse, or we're taking the cart now and we're putting it in front of the horse. The other thing I found with that for me, it does a couple other things if you're a realtor. It's like getting a new credit card in the mail. What's the first thing you do? You go have dinner, you go buy something. Well, I tell somebody they're approved, we're not going to look for 90 days. 9 out of 10 of them write a contract in the next 20 days. It takes the stress point and puts it ahead of the fund. So now I'm the bad guy. I'm the guy who comes in and ruins people's dreams. I also make you very happy, but if we do that before you go look at a home, you're not going to take somebody to look at a home they can't afford. You're not going to spend money on a home inspection. You're not going to do things and be out of pocket for an appraisal and all these other things, only to find out that you can't afford the house, or that there's something on your credit report that we didn't see, or there's a system we use called Fraud Guard. It pulls up everything you've ever done in your life, and it knows everything, and something might pop up on there. So what this does is it takes the stress point and puts it in front, and you go out as a qualified buyer. Prime Lending even has a $5,000 close on time guarantee for certain properties, and you're good to go. So if you're a listing agent, which offer would you rather take? Somebody who's already been to credit underwriting, or somebody who's got a pre-qual letter? And in that case, even the credit qualifying or the credit underwritten borrower may even in some cases be better than your cash buyer.
Well, you make it really aggressive for the realtor to be able to say that we are as good as a cash buyer.
Mm-hmm.
What's the typical timing on closing from the time of a pre-approval subject to appraisal? Assuming that contract terms are all resolved at all,
So I don't wait for attorney modification to get worked out. I will for ordering an appraisal. Attorney modifications have just gotten to the point where sometimes they drag. And they never adjust the closing date when they drag on their attorney mod for 3 weeks and you had a 30-day closing. So that is stop. I'll just back up. So Paul, to answer your question about how quickly we can close, a typical appraisal takes about 10 days. So I would say 14 days is on the short end of that. I promise every person I can close them in 30 days. And I would rather tell you I can close you in 30 days and close you in 2 weeks and under promise and over deliver than do it the other way around.
So we bought our condo roughly about 2 years ago, and when we bought the condo, we did exactly what you said. Got a pre-approval letter, and we closed in 15 days.
That's amazing.
And
It's really fast.
and as you said, our offer with the pre-approved financing guarantee, well, whatever you call it, financing, we'd actually outbid somebody who was giving more money in cash versus financing. So we're
in a good position.
I'm your
You touched on condos. Condos present another unique challenge. Most people don't understand that I have a 800 credit score, I have low debt ratio, I'm a solid borrower. Yes, you are. But the condo building also gets underwritten, and neither of them has anything to do with the other one.
correct.
So
Condo has to do with their
financial
The
Financial
stability.
reserves.
the
right.
reserves.
And the overall condition of the
How well are they
HOA.
maintaining?
How many are leased?
I had a deal last year where they were trying to sell, and it was a structural issue. They had to replace all the balconies on the outside of a building, and they had a problem in their parking garage. And they said, well, it's not a structural issue. Well, the last couple months of minutes, you talked about it as a structural issue, that the balconies were starting to fall off of the building. That is a unique problem, but it can be made easier by putting 10% down, because then you get what's called limited review, where I don't look at the budget, I don't look at all these things. There's a short questionnaire you answer, and really the only thing that'll trip you up there is pending litigation.
Well, it sounds to me like you might have done the buyer a favor. Because that's
They
actually
never
assessed
see it that way. They never see it that way.
Did they buy
Like,
it? Did they close that deal?
I would go as far as to say, I always find this fun too, is if I was a real estate agent and I was going to list a condo, I would have the condo questionnaire filled out ahead of time and get the budget ahead of time, because I might spend all this money on a virtual tour, spend all this money advertising this condo, and find out it's a non-warrantable condo, so I can't do a Fannie Mae loan. I can't do, you can do loans on non-warrantable condos, but there's a surcharge on them, higher down payments. Prime example, would you have guessed that the John Hancock building is a non-warrantable condo?
Oh, is that because the majority of it's retail and
Yes.
commercial? And
Yep.
that it's the, but you know, the
And by floor it isn't, but guess how that building's shaped?
oh, yeah.
As a,
Sure.
almost
By
like
square footage.
a square
Right.
footage.
Yeah.
But it's the, but you know, the issue that you, it's a great idea. The problem is with HOA charges and fees, what they tag on getting documents in on it. If you need it expedited, it's ridiculous. So I can't imagine a realtor walking with all these documents in advance of putting an offer out there, because just it's onerous.
I think a lot of it has to do with pre-preparation, right? And from what I'm hearing from Chris is that majority, if you have a really good relationship between the realtor and the lender, and well, even before the attorney is involved, you know, a lot of the hassles that a potential buyer would have to face might be eliminated by just having a realtor. In fact, our realtor was the one who suggested, you know, hey, go get the pre-approved letter first. Then we know what your budget is, and then we can look for that particular range, and then we'll go from there. So
And that's the right way to handle it. And I think really in to follow up with your comment as far as having a 22.1 disclosure in advance, it's really the seller should be taking that prerogative and having it available at the outset, because then you know what you have to deal with as a seller related to your own building and the limitations and the issues, so you can prepare for it appropriately.
conversely, I would argue that a buyer's attorney should also be just as much interested, because buyers beware. You know, you're buying.
It's part of our attorney review letter. We get it at the outset.
We get it at the outside.
But not every lawyer submits it at the outset, because they want to make sure that everyone's approved, that price is
Right, so they don't
approved
get the document and look at it
until
and spend the money until the mortgage is approved.
Exactly.
But the mortgage isn't really approved
Until they
without
see
the
it.
condo docs. It's,
And that's where somewhere such as Citywide comes in handy, don't we? We have something called the CPAS that actually orders all of that stuff for you without you having to invest all that money. So I think Citywide has eliminates that process of the cost and financial burden on, you know,
Well, that's a great product. I wasn't aware of that. I mean, that's why I'm now here to learn about Eat, Drink, Real Estate. It makes so much more sense.
Yeah, I mean,
but the CPAS, I'm assuming that the cost is then passed on at the closing, but it's done in advance on credit, or how does that actually work? know?
Yes, I believe the way it works is that CPAS does. I think it's not just CPAS. CPAS does not just the condo part. They also do the mortgage verification. So they find out what the payoff is. They get the payoff letter. She pretty much does, like, you know, a lot of the stuff that attorneys don't want to do. You know, they get it done. So why? Because they have the systems in place that helps out.
I'm going to look
And
into
I'm going to
it. That's a
let,
great-
you know,
well, it's a conversation for another gentleman.
The attorney
For-
does it, we assist the attorney.
Yeah.
right. I mean, that's when,
No,
you know,
no,
you
invariably
contact
we are.
your citywide rep and say, hey, you know, can you please tell us a little bit more about CPAS
Sure.
and help us
Makes
out?
sense.
well, and the nice thing is the decks and bylaws are all public documents. They're already recorded. They're not hard to
No, but the
find.
22.1s is what's the key. Because you want the recent minutes, like you said, the structural, the
I
minutes are
never
recorded.
want minutes. I never want to see minutes. There are
'Cause then
times we have to see them. So we all remember the building that fell into the ocean. in Florida.
Sure.
Yes.
They had $12.5 million in deferred maintenance in their parking garage.
Wow.
And that's what gave way, and the whole building followed.
But they realize that all the money in the world's not going to fix it. That's why they.
Well,
that's
and,
probably why.
and Florida, we're going to take Florida off the table because Florida's got its own rules for everything in lending.
Yeah.
But there's a new question now that is on there, and it says, are you aware of any deferred maintenance in your building? It used to say, is there any? And nobody would answer that question. If I was a lawyer, I wouldn't tell you to not answer that question because you're opening
So
yourself.
taking on.
So they've changed the wording on it to have you been made aware of, or are you aware of, depending on the bank you go to. The question's slightly different, but it's softened. There are large professional management companies that manage a lot of these bigger buildings, and they
Sure.
still refuse to answer that question, which I find interesting. You either were made aware of something or you're not made aware of something. And if you don't answer it, that's when I have to get your minutes. There's stuff in those minutes that I never want to see. It's like, I don't want to see your home inspection report from the home inspector. I want to see the appraisal, but I don't want to see things in that home inspection that I don't need to know about.
Because a lot of it is just, it's not evidence, right? It's not something that's,
A lot of the stuff at a home inspection can be overkill.
can be
right?
overkill, right?
You know, like, oh, this plug is loose. I don't care.
Right. So, tell me a little bit more about the differences between, say, a banker and a mortgage broker, and how does it impact a potential purchase?
It's a very subtle difference. The biggest difference, there's three different types of lenders. There's a true mortgage broker that doesn't use their own money to fund anything. Then there's a mortgage banker, an IMB, where they have a line of credit with a bank, and they will fund it and then immediately sell your paper. And then there are banks. The company I work for, we're owned wholly by a bank, and we use their warehouse line. So we're kind of a cross between an independent mortgage banker and a bank. The nice thing is the bank leaves us alone and lets us be a mortgage company. So mortgage brokers will shop it around and always try and find the best deal. They typically do none of their own underwriting in-house. They also don't do their own funding because they don't have money. A mortgage banker is very similar in the fact that they'll shop it around, but most of the time they will fund it in their name and sell that immediately to the investor off of their warehouse line, usually at the table or the next day. Where you get into banks and some of the larger companies, like my company, we sell directly to the GSAs, Fannie Mae, Freddie Mac, Ginnie Mae.
GSAs is the government-sponsored agencies, such as
Government service agencies.
This is the government service agencies,
So
which
they,
are government-sponsored entities, technically in the way that they are
quasi.
quasi. Right, I remember that quasi in the sense that
They're,
they're not really lending. However, they're the backstop. In other words, if the
they're
loan.
independent companies you can actually buy stock in. So they're not government agencies, but they're government backed on a certain level. And so we generate pools of mortgages, and then we sell the pool to your 401k or to a real estate investment trust or whoever's buying mortgage-backed securities that day. So there's subtle differences, but we use our own money. The nice thing is when you
say you use your own money, you mean you originate the loan using your own money and then you sell it off, right?
Right. We put it on an internal line in the company, and then as we sell that loan off or we sell off that pool, that becomes paid back, and that money then becomes reavailable.
So ultimately, prime lending has its own credit facility available. That's what you draw on as a warehouse line, and you close a transaction, at which point thereafter you'll then package it and resell it.
Right.
And again, the traditional banks are the ones who not only originate the loan, but also maintain and service their loan,
Right.
in other words.
But that's at the national level, even at the smaller, at the
Well, and at
local
the-
state level?
Yeah, but at the larger banks, there's an inherent value to that servicing. The big banks want so many pieces of your wallet. And they look at a wallet and there's the credit card piece, the checking account piece, the mortgage piece. And there's been a massive change in large national banks. Jamie Dimon was the first one to do it at Chase.
The Chase.
Chase really cut down on their external sales force and really only wants to do mortgages for Chase clients at this point. Mortgage is a high-risk, lower-margin business, and there are more profitable ways, commercial real estate being one of them, indirect auto being another, for the bank to make money and give a better return to the shareholder. But at the same time, you need to stay in that business. There's government pressure to be in that business for low-mod housing.
The CRA, the
Community
Community
Reinvestment
Reinvestment Act.
There's the need to do that, or you can't even put in an ATM machine. And they want that piece of your wallet because if you go to another bank, then the other bank's going to start marketing for your other pieces of that wallet. And
You also have to have a certain amount of collateral to support the other side of lending. For example, like the car loans and the credit cards are by definition unsecured, and you've got the mortgage lending to offset the unsecured portion of that loan, right? For
Part of the debt
for
to income ratio you're
Chase.
talking about.
For
Well,
Chase.
No, the mortgages mortgages are just securitized, which is why in a mortgage pool, if you do a Fannie Mae mortgage pool, every loan in there meets the same standard. They fit the same guidelines. So it's very easy for me to come to you and buy a mortgage-backed pool that you purchased.
Mm-hmm.
And then for me to turn around and sell it to somebody else because you know exactly what you're getting. You know the performance of it, you know the credit standards of it, so you know what you're getting. So by creating those pools and securitizing those on a larger scale, that allows the banks, a lot of that money goes into pension funds. A lot of it goes into bonds. Our parent company is the second largest issuer of municipal bonds in the country. Well, what a great thing to back a muni bond with than mortgage paper.
Mortgage, yeah.
So mortgages
And the muni
get,
bonds are the ones that help build roads and bridges and
we could get into
all
a whole
infrastructure.
economic class of what happens to your mortgage after you close on it and where that paper goes, but it goes into a lot of different places.
So, so that's the banker versus mortgage broker kind of situation. In other words, from what I understand, what you're saying is, how much risk does an entity bear, right? For example, the mortgage broker has zero risk, and a bank, which carries its own loan, has the highest risk of default.
Yes. There's another, and I wouldn't say it's a subtle difference, regulation.
Regulation.
Mortgage brokers are regulated by the state that they do business in, and will typically have to apply for a license in every state they want to do business in. And then the originator, the person you're talking to do your loan, will also then have to be licensed in that state. If you go to a bank and you see the initials NA at the end of the
National
name,
Association.
that bank is regulated by the Officer of the Comptroller of Currency in Washington, D.C. My company is owned by a federally chartered bank, and we have
Opposite
that
of this.
advantage because I don't have to do state licensing testing. I don't have to individually be licensed in every state. My company is licensed in every state now. There are states I simply won't do business in. I'll never do a loan in New York. I have to take an exam, the ongoing cost. New York can stay New York. Hawaii
Florida.
is very difficult.
Hawaii
Florida is very easy to
difficult.
do business
It's
in.
easy, okay.
The Midwest in general is very easy to do business in. But by having that federal charter, I don't have to worry about whether I'm individually licensed in most states. I think I can do loans in 38 states without getting an individual license. My office has licenses in several states around the country, Arizona, Florida, follow the retiring people.
So you said your bank is a national association?
Yeah.
Okay. And what's the difference between a national association and Office of Thrift? Well,
The federal charter.
Well, the
Uh,
federal charter is
they're both
the-
are federal charter.
So if you go
one is
to
a savings and loan association.
a
one
very
is
a very good local bank around here is Countryside State Bank.
Yeah.
Hence the word
It's a state
state
bank.
bank. It's chartered.
State chartered.
State chartered and is ruled by
State
Springfield.
rules.
So they have a different exam. They have different rules. One of the other things is
Credit unions.
and,
That's
and,
another.
and we follow these guidelines, but technically, I don't have to follow the Cook County Predatory Lending Database. We're
Correct.
exempt because we are a federally chartered institution. So we don't have to follow that
Local rules.
guideline. We do, but we don't have to.
So we're talking about the housing scenario right now, and the buzzword that I'm hearing all around is the NAR lawsuit impact. And we were having a little bit of a chat before our podcast began. Chris, do you want to talk about the lawsuit and how
Well, I'm
what
gonna,
impact?
I'll
I know
start-
you have one answer, and I know you have another
well,
answer. So
I'll
let's start
off
with you.
by saying for the first time in a long time, something that's gone crazy in real estate is not the lender's fault. So I'm very happy that we get to sit on the sideline of this one. For me and for lending right now, Fannie Mae, Freddie Mac, FHA, VA, USDA have all come out with guidance on this. So the lawsuit stated that you're not allowed to advertise commission rates anymore, and that you have to disclose what you're going to be paying to the buyer's agent. We are on the sidelines on this. It, for me, is a non-issue. We will not be financing buyer's commissions. That is not coming anytime soon. It will probably never come. So from a lending perspective, it's business as usual.
Well, the reality is that lenders have been financing buyers' commissions forever. The only difference is there won't be a line item on a settlement statement as an additional cost that's identified to the buyer. Because without the buyer's money and the lender's money, which funds the buyer, there is no closing. So
Well,
the distinction is in the lawsuit is that the right to contract and to then control what someone else is being paid is considered to be, that was the issue that really came up in that lawsuit. So it's not, and I think Chris, you're right, is that I don't think lenders, let alone buyers, are going to be able to tack on an additional expense of 2 to 3% of a purchase price of their home to do the acquisition. So my comment in saying is that, well, it's the buyer's loan that funds the deal, which funds the commissions.
Well, the commission was funded by the seller. And the seller would pay the listing agent, let's just say 5%, and then split that between the buyer and the seller. So the money came from the seller, not the lender. Where NAR got in trouble, and every time they made an argument, they made their case worse. NAR would get in trouble by saying, one of their slogans was use a realtor to buy a house, it doesn't cost you anything. Well, in effect,
It does cost
it
something.
did cost
though.
you 2.5% because that money had to go somewhere and it went into the price of the home. So it really did cost the buyer. I bought a house years ago down south, and when I went to sell it, I discovered that every agent in that area charged the exact same commission, and not one of them would come off of it. So there was price fixing. So it's going to be very interesting to see how this whole thing shakes out. It's going to take years. And NAR, I'm going to sit on the sideline and just do my job and see how it happens. I'm very happy that on a day-to-day basis, this does not affect me right now.
And I can speak a little bit as to how this is all a real practical perspective on it.
Yeah, let's talk about the practical
And it's
perspective.
and I-
So,
and-
at the end of the day, when we go to a closing table, I get a master statement, and and then that's where every single line item is listed. So you're telling me that how does the NAR lawsuit affects my master statement?
Your master statement will reflect compensation to the involved agents. It is up to the buyer's agent and the buyer, with their consent, to negotiate the appropriate compensation that they would receive from the seller.
Which means the buyer's agent, correct?
The buyer's right, from the listing agent.
Which has
and
been
the
engaged by
seller.
the buyer, and
Right.
technically the buyer's cost.
Right, so ultimately, a buyer's agent, with the approval and disclosure to the buyer would say, I'm going to negotiate with the listing agent for a share of the commission of that they're contracted for. It might vary. It might be zero. They might come back and say, we're not offering you anything. Which is really, it takes away the power of the seller to dictate what the buyer and the buyer's agent is entitled, not the buyer, but the buyer's agent is entitled to. And that's where there's going to be a lot of fear in the industry too. But as Chris stated earlier, it takes a little time and it'll all find its way out. And some of the solutions that we're already finding is that sellers and buyers agents are entering into exclusive arrangements to protect that relationship, to make sure that they're compensated for it. They're also you're also finding that buyers agents are negotiating earlier at the outside with the listing agent to determine what is the room, what is the accommodation, what are the recommendations that the listing agent has made to the seller. I have not heard of one transaction yet where a buyer's agent is not being compensated by the seller, because the seller recognizes to drive the best quality prospective purchasers, you have to incentivize the realtors as well, because after all, it's their clients.
100% of zero ends up being zero, right?
Oh, yeah, absolutely. And it can also sit on the market longer than it should have.
Right.
But we're also seeing the flip side of it, is that there are plenty of unscrupulous listing agents that will just not communicate effectively with a prospective buying agent because they want to be able to keep the double commission without having to link. And I say that from personal experience on a transaction that we just got closed out on just in the last few weeks. We did not close it. We were actually, the listing agent refused to communicate with the buying agent, which then, and it was part about, let's move forward, what's the structure, what's the, and of course, what do we know is that now it's under contract and it's likely going to close with the same agent handling both sides of the transaction. You're also going to have a lot of fear, is what we're seeing with a lot of newer agents that are out there. And it's a matter of staying true to their trade is where they have to be and stay committed. But there will be, at one point in the last couple of years, there were more agents licensed in America than there were houses for sale. I mean, that's how...
The lower end agents are going to go away.
Yeah.
The agent who does one or two loans or one or two purchase deals a year,
Mhm.
or one or two listings, they're going to go away.
They're not. It just won't be. They won't be able to survive in that marketplace.
The one positive of this that very rarely do I hear people talk about though now, the buyer's agent now works for the buyer. Before they worked for the seller, which nobody really understood. That agent worked for the seller, even though they were your buyer's agent. They were working for the seller, so now they're going to be working for you. So they're more of your advocate. The rules on that just flipped 180 degrees.
And that's, I differ a little bit with your statement. I think in principle, because of the payment would be coming directly from the closing upon success from the seller's proceeds, it's perceived that way. A lot of the agents that I've worked with over the last several years are recognized already from the outset they're going to get paid. So they're colorblind not colorblind, but they are buyer's advocates at the same time. They know that once that contract's signed, that deal is done, it's going to close, assuming that the financing happens and then there's not, that the house isn't a catastrophe after inspection. So I've seen it on both sides. Your observation's correct on the visual. It's very much more clear that it's that way.
The practicality and the legality of the situation were different.
Yeah,
what
that's
you're
true.
saying is correct, where the buyer's agent would represent your interest as a buyer, but legally,
Oh no, that was the biggest issue with NAR. No,
they worked for the seller.
You're dead on point. I mean, you're right as well, and it's and that's what drove that litigation as deep as it is.
I mean, the practicality of the matter is this. I mean, all the closings, buyers' closings that I've done, the buyers are like, please let me know where to sign and give me the keys. I want out of here.
Right.
I don't care what I'm signing. Whereas the sellers, they're nickeling and diming every 5 cents that, oh my God, there's 5 cents off here. So I mean, I think that also has a lot to do with it. It was so much easier. Why am I giving a tax proration?
Boy, I
And
don't know
then
how many times I've explained that one.
Here I am trying to tell the potential buyer, when you get the bill, please pay it.
Yeah.
Don't call me here for a
You're
year
getting
from
the
now.
money now.
You're getting the money now to pay
It
later.
may not be in your bank account, but it's less money you bring in to close.
That tax proration, by the way, is a lot easier when you do state loans out of Illinois where the taxes are in the same year.
Oh my God, it's the whole thing in arrears is always a challenge.
So, I mean, I think that's probably why a lot of the NAR situation came up to fraud. Is that your idea?
No,
or
it wasn't fraud, but it was.
Well, fraught in the sense of,
fraud.
like.
Yeah, it was. They had a really good thing going. They had a really good thing going, and.
Was it the economics of it that?
But it just got
or
better
the legalities?
because now anybody goes the typical contract 6%. Now it's much more flexible as to what the seller can agree to pay or not pay. I mean, you're
What's
gonna
the
see
practicality of it, though? Has it changed? Is it just
that. Oh, I
business
think
as usual?
I think you're going to see more and more 4% deals all day long, where they say that I'll give the listing agent 2.5, and you can throw a 1.5 out there for everybody because they're not required to do.
I think you're going to see commissions come down by a third for realtors.
Okay. Well, realtors start budgeting right now.
It started 8 days ago, so we don't know.
Right.
We're all guessing. We're sitting here and we're guessing about the future. And if we all knew
Well,
the future,
preparing.
none of us would be sitting here because we would
Absolutely.
have done some stock trades last week.
Yeah, who'd you buy? Who'd
So-
you shorted? That's the question.
So with the shortage in inventory that's going on right now, and there's some I think there's some disconnect between the inventory that's out there for sale versus what a buyer would probably want to buy, in the sense that you might have properties that are dilapidated, distressed, and you may not get the same kind of financing. And Chris, you were telling me something about certain options that at least Premier is offering, and other lenders are also offering.
Prime lending.
Prime lending, sorry, such as renovation loans, etc. Can you talk us a little bit about that?
Sure. So it used to be the only type of renovation loan was an FHA loan, and it was called a 203K, and they still exist. They have some drawbacks in the sense that you need to hire a consultant if your loan is over $35,000. The renovation cost is over $35,000, and there's some red tape involved. Conventionally, you can do the same kind of loan. So I'm going to keep math easy here. You buy a house for $100,000. You're going to put $30,000 into it. So your acquisition cost, let's say it's $130,000. Put a 5% contingency in there, so now you're up to $135,000. You can put as little as 5% down to that $135,000. You're financing the renovation. As long as your house praises at what you're putting into it or more, you're in great shape. And so you can go and buy a house that needs work and not go, wow, I'd really like to buy that house, but it needs $20,000 in a new kitchen. Well, if you can afford to finance another $20,000, you can do that kitchen and start the day after you close. The other side of that is sometimes, and I see this with estates a lot, where, your parents lived in a house for 30 years and the last time they updated it was 1972. Accept the fact that the house needs some work. Maybe put a brochure in there that talks about renovation financing. You're going to sell your house below market value for a similar 4-bedroom, same square foot house because it's dated and needs work. Well, that buyer can come in there then and fix that home up, not have to save up more money or wait for the house to appreciate so they can take out a home equity line. But they can come in there and do the renovations, finance those renovations.
To their liking.
To their liking, to their taste. And sometimes it's just taste. The thing to be careful of, though, is when you're doing this, not everything you want to do is going to add value. Prime example, a roof. You don't get any value for having a roof on the house that doesn't leak. People kind of expect that. Landscaping doesn't really typically add any value because that's your personal taste.
A pool.
Pools are kind of neutral now. They've come a long way. And in the South, you get value for a pool. Where you'll always get value is kitchens and bathrooms. You put in new countertops and spruce up a kitchen. you're going to get a very good return on that. You can get,
So kitchens and bathrooms over roof and pool.
yes.
Or roof and
Landscaping.
Make sure the roof
landscaping.
doesn't leak.
The roof
And-
doesn't leak
Right, I
out,
mean,
right.
when you look at a house as a buyer and you go, oh, the roof leaks, with the roof not leaking, you're not going to pay more. You'll pay what they wanted for it because you expected the roof not to leak. So the renovation loans are a great way to go into a house that needs work and get a contractor in there, have them write up a bid, and see if it fits your budget. And then you could buy that house and have the work done right away and finance up to 95% of that.
So from a practical perspective, and this is just really the mechanics, is the money held in with a title company pending completion with submission of mechanics?
We
liens?
hold it in an escrow
Releases?
account
Okay.
at the bank.
And subject to the.
We go out and do an inspection. Right, we're not going to just give you the money because you said you renovated the
I think
kitchen.
it's
We're
important
gonna,
to clarify. That's
Yeah.
why I'm asking. Just to
so
make
we'll
sure.
go out and do, depending on the size of the project, 1 to 4 inspections.
So traditional construction financing is how you would structure it, with
Very
title
much.
escrows and mechanic lien waivers
Yes.
and whatnot.
Yes.
Okay, good. I mean, I think it's important to understand that. But the at the date that you close, you're paying your P&I at 95%.
You're paying
Principal and
you're
interest.
paying the entire loan out from day one.
All right.
Because that money is set aside, but the loan itself doesn't wait for the completion. That loan, you can't make it so that you have a certain amount of payments at $1 amount and a certain amount of payments at another. And so just for the way of drawing up the security instrument and everything else, you're drawn out. So if it's $100,000 to buy the house, you take that $100,000, put it over here, and pay out the seller and everybody else. The $35,000 for the renovation goes in here, and I had that $5,000 cushion in there, say for contingency reserves. If that contingency doesn't get used, it just gets applied to the principal. So from day one, you're paying on the whole amount, but most of this is going to be done in 30 to 45 days most of the time.
That's good. I mean, it makes a lot of sense. You don't want the buyer going back to the closing table and resigning
No,
docs and whatnot
no.
either. So, but that's good. Just these are common questions that we would have. When,
The other one, and it's good for both of you as attorneys to understand, is there's buyer and seller funded repair escrows. Say the house needs a new roof. The seller doesn't want to come out of pocket for it. Get a bid. It changes a little bit on the lock because we typically have to lock until completion on those repair escrows, not funding. But say you need to get that new roof put on, and the seller doesn't have the cash to do it for whatever reason, and it's $15,000. You can put that $15,000 in a repair escrow from their proceeds from the sale that we will then use to pay the contractor who puts the new roof on. So anytime,
Who holds the money in that scenario? Okay, the bank?
We
or-
do.
Okay.
and so that can be buyer funded. Say it's something that isn't required, but you just don't like the cracks in the driveway and you want to fix them. You can put that money in there. So you don't, that same thing, you can fund it at the percentage you're doing your purchase at, whether that be 5% down, 10% down. You put that money into the repair escrow and we'll fund the opposite side of that percentage. So if you've got a deal where it's falling apart because there's repairs that need to be made on the house and the seller doesn't have the money to pay for it until they close and you get in a catch-22, hey, we can make that deal work. And a lot of people are just unaware of the concept of a repair escrow.
now, how is that different than? I know how different it is, but can you also have a closing cost credit?
No.
All right, so it's one or the other.
The problem with a closing cost credit is it has to go to closing costs and prepaid items. And there's a limit on that from 2% to 9%. Most of the time you're not going to get over 6%. And at 95%, or I think it might even be 90%, it's 3%. So if you're buying a $100,000 house, you
Who
want
puts those limits? Is it the FHA? Is it the
FHA
entities?
is
Or-
always 6%.
Okay.
Conventional has a sliding scale depending on whether it's an investment property or or the amount of the down payment you're going to use.
That's for your closing cost credit, or that's
For your
the-
closing cost credit.
And that's independent than a repair escrow. 'Cause
Correct.
You could, But you can theoretically have both then. You could have a seller's.
You could do both.
That's really my question is, can I have both?
You can have both. But what you can't do is have, say you're buying that $100,000 house, you can't have a $15,000 closing cost credit. The closing cost credit has to actually be spent on closing costs.
Yeah, it should not exceed your actual closing costs.
So, if you give a $10,000 credit and the closing costs are $7,000, then you got $3,000 that, as attorneys, you get to figure out how to handle.
So then let me ask you this. I mean, what if it turns out that the buyer's realtor has a closing cost expense on the settlement statement that the buyer needs to pay? Can that be a closing cost credit? Because that's theoretically funded by the seller. Would that not apply because it's an expense now of the buyer?
I'm going to say most likely it could be.
Yeah, I mean, I think within reason is
Within reason, we're not going to, you're not going to pay for a virtual tour or,
No.
things like
I'm
that.
talking about the 2.5% that a buyer's agent would be entitled to for the work they've done. Can they make that a closing cost credit, an expense on the buyer's side that can be then compensated by the seller as a closing cost credit?
We just went back to what we're trying to get away from.
Well,
That's where we are right now.
But
it already is.
No, but it all shows up on the seller's column. On a closing statement, all the real estate expenses are always on the seller's column.
Yes.
But
And
now
it's going to
it's
be
on-
interesting to see how that goes going forward.
Right, because if it's on the buyer, now if I have an expense and the seller refuses to pay it, but I negotiated that they give me a closing cost credit to be applied towards my title fees and my whatever.
Fannie Mae's guidance on that, and Freddie Mac was in lockstep on this. In markets where traditionally the seller has paid for the real estate commission, the buyer's agent commission will not be considered a closing cost credit.
All right, so there's already been some
They're not going
Agency
to.
discussion
on
on
Yes.
yeah. So there's already some quote unquote revenue rulings on it.
There's-
And one of the bigger ones was VA came out and said that they will be allowed to pay, the veteran will be able to they will be allowed to pay for the buyer's commission.
Wow. Leads to some interesting discussion. You're right. The next few
That is
years
some-
are going to be really cutting new. We'll be definitely hitting some new parts of the industry.
And we
There's
don't
no
even know if
question
this is
about
going
it.
to stick.
Hey, you know what? We were talking earlier, Chris, and this I was really excited to hear about it. Tell me how Prime Lending is using AI solutions in the underwriting process and in the pre-approval process.
So this applies primarily to non-government loans, so Fannie Mae, Freddie Mac, agency-backed loans, not FHA and VA. We've gotten to the point now where artificial intelligence I will send you a link, or 99% of my clients now apply online. And as you apply, it's going to ask you if you want to pull in bank statements. And it will pull in the last 60 days of your bank statement. Hopefully that's your personal checking account that you get paid in. What you get is you get a paper file that shows me your bank statement for the last 60 days. Behind the scene, depending on your bank, there's a digital file that pulls in up to 2 years of that bank account. The digital file gets read by the automated underwriting system, and it will spit out an income number for me. As long as your debt to income ratio is under 45, it will tell me what your eligible income is.
That's amazing.
The advantage to that, and I had one this morning, we have a borrower who has a job as a welder, makes good money and gets overtime. But he's only been on his job a year. The rule on overtime is I have to average your last 2 years of overtime. You can finagle with that and maybe use it for a year, but let's just say you got to have 2 years. Well, I pulled in his bank statements electronically, and there's some technical stuff on my side. You put it all in as base income. You don't break it out into different categories. But the artificial intelligence reads that behind the scenes, and it spit out a number higher than what I was going to use to underwrite this file. The beautiful thing of that is, you already gave me your bank statements. So send me your driver's license, because I got to do a Patriot Act form. And then let me think, I'm done. I got your bank statements, I got your income, and we get what's called day one certainty. I'm done. You just did an application with, you gave me, you physically gave me, you sent me a picture of your driver's license, and your file's going to underwriting and it'll be approved the next day. I don't need W-2s, I don't need pay stubs. People have a fear. There's an
That's remarkable.
There's an
yeah.
interface, there's different
Scary
systems
how
that are
much that
used.
happens.
People have a fear of this. They're like, I don't want to give you my banking password. The interface doesn't share it. It's a single use thing. It pulls it in once and it dumps it into my system and it dumps it into AU. And what's, oh, I don't want to give you my bank. I don't want to share that. You just gave me every bit of personal information about you. If I wanted to go out and open a new credit card in your name, I have more than enough information.
Yeah, you don't need to.
And people get very, I don't want to share my banking. You already did. So you'd rather email them to me and then an unsecure email or upload them into a portal.
Yeah,
But
there's the-
this AI, it allows me to do things that I may not have been able to do, and it makes the process easier.
Oh, and faster.
So it used to be you'd sit down, hey Chris, what do you need to do my loan? Go online, fill out the application, and when it asks you, pull in the bank statements, and it'll also pull in your pay stubs. It hasn't gotten to the point where it's able to read those yet, but probably by the end of this year that'll be there. So I'll call you back and tell you what I need because you might be pleasantly surprised.
That quick.
It's 25 seconds.
So that cuts down on a lot of the transaction time and, of course, time.
Time, but not cost. Yes. The technology fees involved in lending have skyrocketed.
Oh, no doubt.
Understandably.
With security and with analysis and with.
With limited amounts of vendors who realize that you really want to use this technology and make you pay for it.
It's also sticky. Once you're in, you can't get out.
No.
To move all that data and to go and migrate.
And
it's
as
it's
hopefully this funnel opens back up and we become busier and busier again, loans will still continue to move at a much quicker pace than they did 2 years ago.
awesome. Awesome.
There are a few questions that I want to ask from a buyer's perspective, for example, and these are, some of them that are really silly, but I just wanted to ask anyway.
Never a silly question. I do this every day, the buyer doesn't.
So the first thing is, I don't have 20% down. What impact will I have in a multiple offer situations?
None.
None.
The approval letter that I will give you to go write your offer does not say how much you're putting down. It says how much you can afford
On the gross value of a home,
on the purchase price.
but
Yeah.
not on the loan amount.
Not on the loan amount. That's going to be on your contract, but it's if you're already approved, it'll have the loan amount that you're approved for, so you can back into it. But actually, what most people fail to understand, and it's counterintuitive, lenders are in a better position if you don't put 20% down because of private mortgage insurance. We have less risk.
You have less risk, right? What's the difference between an FHA loan and a conventional loan?
FHA loans are designed, on the surface there's not a big difference. FHA loans tend to be a little more lenient with greater forgiveness for transgressions in your credit history.
I see. Okay.
For example, if you file bankruptcy, you can get an FHA loan.
2 years.
2
after
years.
discharge.
Conventional's 4. Foreclosures 5 years for FHA, 7 for conventional. So there's different standards. The other big difference is on an FHA loan, you pay a 1.75% upfront funding fee that gets financed into your loan.
How do you anticipate the mortgage industry changing come November 2024?
No. if the guard changes?
I'm going to stay away from the third rail.
Well, you're riding a donkey, you're riding an elephant. We'll figure out where you are.
That is a tough situation.
What about, what do you see the feds doing in the next couple? That's another interesting doozy, isn't it?
The data for
interest rate.
the data for the Fed this Friday, the Consumer Price Index comes out. Behind the scenes, there is, even though the unemployment numbers that have come out have looked strong,
Yes.
there is some soft data in there.
Yes,
And when
I've
you
been
when you look at the
watching
non-farm
that.
payroll and you look at payroll pressure, you know, you want $20 an hour to work at McDonald's in California, you just got replaced by a kiosk.
That's exactly right.
There is some softening in there, and if the CPI starts to soften, probably by beginning of fourth quarter, we might see rates start to come down. Now, what I would say to that is don't wait for rates to come down to buy your house. Look at the rate that you're buying your house with as a 6 to 12 month price you're going to pay. But a year from now, that house is going to be 5 to 8% more than it is today. That's money you'll never get back. The difference in a point on your rate, a third of it's tax deductible, you're going to come out ahead.
Well, ultimately, don't miss your opportunity based on the rate. I mean, that's the message that I tell all my clients and all my realtors is that you keep pushing like there's no tomorrow, because if the rates go up tomorrow, then your clients then just put themselves out of an opportunity today.
Right.
So there's the flip side is that, you know, we were at 14, 15, 16% 35, 40 years ago. So, you know, we're blessed to be where we are today. My first house was 7 1/4 back in 1996.
And you have zero control on the rate on top of it. You can see, you know, where the mortgage rate's heading, but most of it, like Chris said, also is a lot of the more, you know, it's all interconnected to a certain extent. You know, whatever you pay in mortgage interests gets reused into, you know, different.
The best year I ever had, rates were at 6.5%. Now they came from 9.5%, so it was a different scenario. Rates should not drive your home buying decision. Whether you can afford the home, whether you're comfortable with it, rates are driving the fact that no one is moving though.
Oh, absolutely. Yeah, I mean, that statistic is unbelievable. Is that?
Why do you think that is?
If you have, let's say, a 2,500 square foot home now,
At
and
2% or
at
3%.
2.875, and you want a little bit bigger home because now the twins that were sharing a bedroom really are getting old enough, they kind of both need their own room. You go and you're going to buy a 3,200 square foot home. It's not that 25% incremental jump in your housing cost. Your housing cost is doubling.
Doubling. All right.
No one's doing that.
It's true.
We're going to make this work. We're going to put a bedroom in the basement. And until rates come down where people can move and not double their home, we're going to have a housing shortage. Illinois is going to have a harder time with the housing shortage, I think, than some other states, because large corporations just don't want to come here and build. And if they are building, I just did a mortgage for a subdivision in Belvedere.
Oh, wow. That's up in, what, Winnebago County? Or
It's
straight-
Rockford.
Yeah.
Yeah.
I mean, their guy built they're
Belvedere's
building
like-
subdivisions in Belvedere now. That's, you know, you got to go buy cheap farmland to make a profit.
Right. It's
And
gotta
to
be
do
worth
that, you got to go west.
No, this is amazing, Chris. You know, I really appreciate the time you put in today on it. You know, and Laxmi, thank you for hosting us. This is tremendous, and I'm not meaning to push it to close, but
Absolutely.
We can
And it's
watch
been
that.
a riveting conversation. Lots more that I never thought that I
lots more to
didn't
learn
know.
too. So it's
Lots more to learn.
Well, thank you both for having me, and I'm glad we avoided the grad school level class on mortgage derivatives. And
Well, I slept through
A
that
special
one.
purpose vehicle.
But that's tremendous. So
Thank you for joining us at Eat and Drink Real Estate, and we hope to catch you in the next session.